come back up again. I had answered in two parts. One is, what's the rate policy coming about from the Fed? And everything we've heard from the Fed is that they're not a big supporter of negative rates. It's not clear that it was helpful in Japan or in Europe. And the Fed has painted a picture in which not just Jerome Powell, but other Fed folks, that they're not inclined to want to go to negative rates. And I believe that. I don't think they want to do that. And it's questionable as to whether that's stimulative or not. So I'd say that's unlikely. However, they can't really control longer-term rates. And to the extent that we saw a 10-year get down to something not far from maybe 50 basis points a couple months ago, traded intraday even lower than that, it does beg the question, could we see some negative yields? I think it's unlikely, just because I don't think the Fed wants to see it. But, you can imagine a scenario in which, if things got a lot worse, and I'm certainly not forecasting that, but let's just say they did, and we saw a deeper recession and we saw a deflationary environment, then it's certainly a conceivability. I think it's a scenario worth considering, but certainly not the likely scenario.
Fair enough. All right. So you're a fixed income guy. Explain to me what bonds have seen this week to cause such a tremendous rally in the fixed income market, and then really this cratering of the 10-year yield from about 95 basis points last week to here we are sitting around 65 basis points. That's a pretty dramatic shock in terms of a move. Here we are down to, like I said, 65 basis points a day, where last Friday we were within shouting distance of back up to 1%, and here we are sitting now down at 65 basis points. What has been the big turnaround in terms of the fixed income market from your perspective?
Well, I think you touched on it earlier when you asked the question, are these two disconnected markets, or are these two linked markets? And we know that they are linked because investors have a tendency to move from one to another. And as we know, when we see sell-offs in equities, we're going to see funds moving into the fixed income markets. And, I don't think it's investors making analytical assessments about whether the 10-year should be at 75 basis points or 85 basis points. I think it's really investors selling stocks and saying, get me into bonds, and I don't care what the yield is. And if you have the mindset, I don't care what the yield is, you'll just keep driving it down further and further. And it certainly could go below the current level of low 60s. It could certainly go lower, as we know. So that's been a very significant shift, as you mentioned, though I will offer the following caveat, and that's this. We're very sensitive to a change in yield that went from, say, 90 to, say, 65 basis points, or something on that order of magnitude. And we think, wow, that feels like a big difference. But I would suggest that from an economic point of view, that's no different than going from 190 to 165. And so, yes, 25 basis points, 30 basis points is a big drop, but it feels bigger because we're on such a small base. Food for thought.
Fair enough. Now, what are you seeing in some of the corporate bonds that might provide a little bit of insight? As are people continuing to reach for yield again? Are they willing to go out there and buy lower grade assets that aren't providing as high yield, or what's happening with some of the credit yields at this point?
Well, up until 4 hours ago, the answer to that question is yes.
Yes.
We did see that. We saw a very significant rally in corporate bonds dating back to early April, just along with the stock market. Corporate bonds, high yield bonds, tend to do well when stocks do well, and we did see that. We saw that repeatedly. We saw spreads not go back to the tights of February, but not far from it. And today is obviously a change in that. We're not seeing a huge gapping out in spreads yet, though that often there's a lag there. But the corporate bond market's very sympathetic to the stock market. And if we do see stocks bounce back from today, and we see a big rally tomorrow, we'll likely see corporate bonds continue their outperformance.
Yeah, no, I brought up the HYG here, which is just basically an ETF that kind of tracks some of that performance and some of that buying. And as you mentioned, up until about 4 hours ago, that was the case. And
Right.
you are seeing a bit of a pullback here today, down 2.6% in the HYG, which is still, hey, I mean, that's markedly different than what you're seeing in some of the equity markets as well. All right, I wanted to go and cover some of the economic headlines that came out today. We already talked about the weekly initial jobless claims and continuing claims, but I want to spend a little bit of time in terms of some of the inflation indicators. Earlier in the week, CPI did not really show any inflation at all. PPI today showed the prices at the wholesale level in May. They did rise 0.4% month over month, but the core rate, once you pull out food and energy, it actually dipped 0.1% month over month. Are we at a point now? Is the fixed income market? Is the data telling us that we still kind of need to be a little bit weary of potential deflationary pressures? Are we out of the woods on that yet, or is that still something that we should be keeping an eye out for?
Joe, I missed you for a second. Did you just say deflationary pressures?
I did say the D word, the
Yeah,
deflationary pressures. Yes,
got
sir.
it. Yeah, I just wanted to make sure. So yes, I think that the jury is still out on that, and that is very much tied to the broad economy and the prospects for things to be opening up. And I hate to keep going back to that, but that's what's driving markets. That's what's driving economic growth prospects or not. And that's what's going to be driving the potential for inflation or deflation. And I think the specifics of the inflationary numbers aren't hugely consequential, other than naturally they're going to be suppressed, and hopefully it's temporary suppression. I don't think any one month's readings are all that critical, but if we revert back to a prospect that's akin to where we saw in March, with massive uncertainty, a resurgence of the virus, things closing down again with uncertainty about timing of opening, then I think we're going to continue to see very, very low and potentially negative inflation. I think that the question I'm most often asked is, are we more likely at risk for negative inflation because of a decline in growth, et cetera, or are we susceptible to positive inflation due to all the Fed stimulus and the money that's being created and the support to risky assets? I think I tend to feel that there's a greater risk of deflation than there is of positive inflation.
Let me ask you this. Then this is a question I'm always trying to answer myself. Is it possible to have deflation in goods and services, but inflation in asset prices? Meaning, is the Fed implicitly encouraging asset price bubbles with their current policy? Can you continue to see home prices go up? Can you continue to see market prices go up without really seeing inflation overall in the economy in terms of the goods that we're paying, or the prices that we're paying for goods and services? Is that possible, or is there a disconnect there?
No, I think you're right. I think it's very possible. I think we've seen it to varying degrees. I mean, the Fed is out there buying bonds. The Fed is out there buying ETFs. The Fed is lowering interest rates, which makes stocks, all else equal, more attractive and creates demand for risky assets. The Fed's not out there buying cars and computers. Right. And so follow what they're buying, and that's what's going to increase in price. So I think you summarized it correctly. We could see asset inflation or asset price inflationary pressures without seeing that transfer into traditional goods and services. Absolutely.
So I heard something yesterday in the testimony that I wrote it down because I thought it was so important when Powell mentioned this. And I'll paraphrase this to a certain extent, but basically what he said is, if we decided that asset prices were too high and we stopped providing support to an economy that still needs it, basically, what would happen? And that when I heard that, I immediately thought, well, this whole idea that rates aren't going up to 2022, That makes a lot of sense because what I'm hearing from Powell is that he and the rest of the Fed don't see asset prices as being too high. What they see is an economy that needs that continued jolt, and that they're willing to step in for, I don't want to say QE infinity, but at least QE a few more years. And when I hear things like that, I don't know. I I wonder, and I think you brought up this really great point is buy what the Fed's buying. I mean, because if the Fed is saying that they are willing to step in because they don't see asset prices as being too high, and if they did, what would be the ramifications of them stepping, taking their foot off the gas? Well, it seems like they're saying that as of this point right now, they're concerned about those ramifications of them kind of taking their foot off the gas. And when I hear things like that, to me that means that this expansion in asset prices can continue, and that's a theoretical conversation, right? I mean, we could basically talk all day about whether we think that's right or wrong, but the bottom line is this, that's a summary of some of the words that we heard yesterday. And when you hear something like that, Brett, like I said, you kind of hit the nail on the head. You said, look at what the Fed's doing, and I guess to paraphrase another person, don't fight the Fed, right?
Yeah, that's exactly right. And keep in mind the easiest single tool the Fed has at their disposal is to support asset prices. It may not be their explicit goal to do so. In fact, in addition to describing a pretty emphatic commitment to doing whatever was necessary to support the economy, jobs, and et cetera, and to help folks that are struggling with small businesses and the massive unemployed. In addition to that, Jerome Powell did mention a support to ensure that markets are functioning, which is kind of an interesting thing because, at some prices, markets do start to function. So it's a little bit of a slippery thing. He was referring to lack of liquidity that occurred back in March in certain sectors, which the Fed supported enormously, and I think it was very positive that they did so. But it's a slippery thing when he said, we have no intention to support asset prices. That is the tool they use, and to inject liquidity into a market and to ensure that they're functioning. That's the words he used. We want functioning markets. That does mean supporting them. And I didn't hear any reporter kind of challenge that, but that there's a little bit of a dance there, just to nuance that point.
Oh, and one of the things you mentioned before is he's very measured in his speech, right? Because he's seen what's happened in the past when he hasn't been, and so those are carefully chosen words, for at least from my perspective. How about some more carefully chosen words today, Brett? And those are on the heels of Mnuchin's announcement that another $1 trillion is going to be pumped into the economy next month, and that's going to take our cumulative United States debt up to, drum roll please, $26 trillion. When's enough?
And just yesterday it was 25.
That's right. I remember long ago, what was it, 2009, when $1 trillion move would be a whole year's worth of move, and here we are talking about a day. So, all right, Brett, when's enough?
Oh, I think there's more to come.
Yeah,
I think that I think that there really is a very strong message that Powell has expressed, and if there's any reason to take a little solace in everything that's going on in the world, it does seem like both parties, regardless of where you fall on the political spectrum, and in their various respective ways, are aligned that in the idea that a great deal of stimulation is needed in the economy, and then they've done that, and I think there is a commitment to doing more. And then the market is expecting more, by the way. And so what will be interesting, Joe, one of the things I'm watching is to what degree the market moves on the news of further spending and support initiatives. And I don't think it's going to move a lot on them because it's expected. So we'll see if that's actually true. But that's
do you think Do you think there's more risk that they don't get the initiatives that they're hoping or the spending that they're hoping? I mean, I guess what I'm asking is the stimulus priced in?
Yeah, I think it is. I think it's very much priced in, and I think that explains a portion of the equity market recovery that we'd seen until, of course, 6 hours ago. But
Right.
I think a large portion of that, half of it maybe, is due to the idea that the Fed has come to support the broad economy, and that more is coming. Yes, I think that is absolutely expected.
So, Brett,
Which, by the way, Joe, I was going to say, just one thing here. It's a little bit of a challenge now because it suggests when the market expects it, it means that there's not much of a follow-through market-wise when it comes about, and that there's only downside to the Fed. I think you were kind of getting at that point before.
Yeah, good. That's a very good point. And that brings up a quick question here from John in Utah. He says, Brett, can you explain some of the tools, maybe some of the tools, I mean, I think we know some of the tools that the Fed uses, but maybe some of the ones that they're using this time that weren't part of the normal playbook in the past.
Sure. So, at the end of the day, it generally falls into the category of either direct buying of securities, which of course they're doing in the government market, and they've done in other parts of the which has recently purchased corporate ETFs and so forth. So there's buying of securities. There's an offer to buy securities, and they did this very early on in the money market space, where they basically said, if you ever want to sell the following assets to the Fed, we'll pay this price. So even without actually buying, just the very offer to buy is a support to the financial markets. Of course,
a backstop, if you will, right?
A backstop. That's exactly what it is. So that was an interesting thing. It's one of those potentially low-cost mechanisms for the Fed, where they could just basically make the statement that they're in there supporting the market. Naturally, we have interest rates, of course. The ingredient that is being talked about now that would be a bit new for the Fed would be to explicitly target a long-term treasury rate, meaning that they would commence on purchases of treasuries in order to target a certain rate. And there was some talk that perhaps Powell would intimate something about that in the meeting yesterday in his press conference, and he didn't go into any specifics other than to say that they're considering it and thinking about it. So that would be a little bit of a new technique. I mean, they're all versions of the same thing with slightly different, nuances, but they're all in that same kind of thing: buying securities, offering to buy securities, targeting rates, generally keeping rates low to the Fed funds rate. So they're all akin to those kinds of things.
What about what they've done? Excuse me, in the muni market. I mean, that was relatively new. They started that back in March, that purchase program. And do you see the likelihood of that continuing, given that you're going to more than likely really start seeing tax revenue receipts drop dramatically for a lot of states, including the one that you and I reside in?
Yeah, they did. That was somewhat new. I mean, again, same idea: buying securities or offering to buy securities, supporting markets. I think the Fed has enormous. It's a hot ticket political issue because municipalities are arguably supposed to be functioning and independent of the national government's efforts. But, and there was some talk from various politicians about whether they should be doing it or shouldn't be doing it. But I think that generally speaking, they are committed to it. The muni market's interesting. I mean, we could be seeing some downgrades with some of the weaker municipalities. To a large extent, that's kind of priced in. But I think, again, that's a place where the market is expecting the Fed to be supportive. And that was a good point, Joe. That is somewhat new for the Fed to get involved in.
So I brought up a chart here of the NASDAQ Bank Index. It's the KBW NASDAQ Bank Index, and I bring that up because of one of the things that Liz Ann Saunders and I had spoke to about a week and a half ago was this idea that the market rebound has really been in a few phases. The first phase was really Some of the beat up sectors, energy, being down 50% at one point, made a heck of a comeback because people were kind of buying, some distressed assets, some of the assets that had really severely underperformed. And so, with that first phase, there was a lot of this idea that, well, there might not be a lot of legs to this because they're just, kind of buying some of the beat up names. Second phase was really more kind of sector driven, right? Some of the healthcare, the biotech names where, they made sense from the perspective of here we are in this kind of this new work at home type of economy. You've got your Zooms, you got your healthcare sectors, these names that are doing well in this type of economy. And who knows if this is the economy, we'll see, continued secular changes. But as of right now, this is the case, right? Where we're seeing money flood into Amazons, to the Zooms, to the different companies that do well within that, work from home type of environment. We were in that shelter in place 2-month environment that we were in that now we're kind of extricating ourselves from. Third phase was really a distribution of some of those assets to some of the other sectors that hadn't participated really at that point. Industrials, materials, financials, you started to see some of those take a bit of a bid, and then you saw some outperformance. And like I said, so the reason I bring back up the banking sector here, the BKX, is because some of that relative outperformance that we really saw from really the second week of May, where we rallied from 60 to 90, we had a 50% move. We're starting to give some of that back here, and I'm looking at this right now, and I'm seeing here we are. We're down 15% this week alone from the highs that we put in just at the end of last week. So when I see things like that, it makes me wonder how much more of this phase 3 rotation is going to be continuing. So I just want to get kind of from your perspective, when you're looking at kind of the macro economy, where do you think does this phase 3 continue? Is there a phase 4? Where do you see maybe assets rotating in the next quarter or so?
You know what? I think the question that I would ask is, where might they go back? And I'm going to sort of take your question and twist it just a little bit. Mm-hmm. I think that now that so many of the sectors in the marketplace have, by and large, recovered, not fully, and to varying degrees, as Lizanne points out in her framework. But the question now is, it's starting to look more likely that the V-shaped recovery that we saw in stocks is not going to be truly reflective of a V-shape in the economy. And therefore, what stocks are most susceptible to reverting? And I think the picture is likely to be one in which we kind of retrace. So I think you were referring to the third or fourth phase in the equity market recovery. I think the question is, how fast or how likely are we to go back a phase? It's kind of like we went from first gear to second gear to third gear to fourth gear now. Are we going to downshift to third, or are we going to downshift to second? And are we going to retrace some of those gains? Keep in mind that those technology companies, the stay-at-home stuff that's done so well, if we are in a turnaround state, and if today is indicative of a little bit more bearishness in the marketplace, those stocks are going to continue to do well. And are we going to see an even greater degree of divergence between sectors? And I think, even though I'm not an equity expert by any means, that would be my biggest concern.
But you do play in the same sandbox, Brett, right?
That is, and happy to.
All right, so I brought this up here because I think that's very apropos with what I'm showing right now, is this performance by sectors. And so I like to look at this not necessarily in a one day, because I kind of want to stay maybe outside of that noise a little bit, the daily machinations from what you see. But I'm looking at this as what we've seen over the last 5 days and 20 days. So really, what does this mean over the last 1 week to 1 month? And so over the last 1 week, you've seen of that money that had, moved into the financials, the industrials, some of these outperformers over the last month, it is starting to come out. Part of what you just kind of brought to the fold here is this idea that, did we see an over rotation? Did we see too much excitement move into some of these sectors, and kind of given maybe what our thought is over the next few months or so in terms of the economy, in terms of some of these secular changes, will that money continue to stay, or will that kind of rotate back out? And so I think that is, from my perspective, that's kind of the way to start looking at things is, maybe not try to pick the next 3 to 30 days, but let's say, where do we think we're going to be in the next 3 to 6 months? One of the things I've been kind of paying attention to, Brett, is looking at kind of what some of the volatility indicators are telling us. So I'm going to bring back up the VIX here for a second. You can actually go to the SIBO's website, and it's just SIBO.com. And one of the things that is helpful there is they will show you the VIX structure over the 30, 90, 120, all the way out for a couple of years. But one of the things you'll notice when you look at the VIX, and for those of you who are unfamiliar with that term, the VIX is basically a volatility indicator of the S&P 500. So it kind of takes, it used to take a weighted average, but now it's got a little different formula now for the 30-day average of the volatility of the S&P 500. And it measures that, and it actually assigns a number to it. So here we are at 42. So basically what that means is, around a 42% volatility over the next 30 days is kind of priced into the VIX, or into the S&P 500. Now that's a pretty substantial jump from, the move down that we had seen. We got around this 25 level. We've been sitting around there for a while, and here we are popping back up. And as you can see, it's about a 52% net change from where we were yesterday. So a big move, right? And what is that really telling us? That's telling us that the markets are expecting this volatility to continue for a little bit. Now, what's interesting, and this might have changed here today, but over the last couple of days, if you look out over the VIX curve, over the 30, the 90, the 120 day, and so on and so forth, you get into looking in the October and the November data points, and they're calling for a lot of volatility. So pretty easy to kind of figure that out. What does that mean? That means that the markets are looking for a pretty volatile election. So let's think about that. I mean, we're talking 3, 6, 30, 60, 90 days in terms of what we're looking at. But what's interesting is we could be in for another 6 months of volatility, Brett, very easily, kind of given what's happening right now in the country. And then as we kind of head into the election cycle as well too. So not saying that we're going to continue to see a 40 VIX, but there is likelihood that maybe we had put in a little bit of a bottom here for volatility for a while, and that this kind of straight move up, as you called it, that V market bottom that we had seen for a while. Well, maybe it's not going to be a V. Maybe we have to look for another letter, but could be that volatility could be around the corner for a little bit. What are your thoughts?
Yeah, I think so. And volatility begets volatility, meaning that, I'm looking right now at the screens and I'm seeing, parts of the equity markets, down 6-7%. And what that means is that tomorrow is likely to be volatile. Now,
Right.
No one knows whether it's going to be up or down, but the idea that it's going to be something very volatile is very likely, because think about it this way. There's the number of investors who are going to look at what's happened today, who are going to either be inspired to think that this is presenting an opportunity in the marketplace, or going to generate increased fear in the marketplace has just increased notably. Everybody, with retail investors, probably know about this right now. If they don't, they'll see it tonight. They'll see it tomorrow morning, and that will create more volatility, and then it becomes kind of a snowball effect until things calm down, like they did in April and May. And so, what does that mean? Yes, you're absolutely right. Volatility is on the rise. We can expect June to likely be a pretty crazy month.
Well, that's interesting. Yeah, no, that's interesting. And I think one of the things that you just kind of brought to light is this idea that volatility is one of those things you have to look at from the perspective of absolute value, right? It can go, volatility can, we tend to look at volatility as a negative thing, right? You're saying volatility means that the expectations of the market will go down. Well, that's usually the case, but volatility really means that, the expectations are for a big move, either up or down. And I think that's important. And this is one of the things I'm going to kind of want to wrap up with here is when I do look at some levels on the S&P where you might start seeing some buyers step in. I'm going to bring in some of these retracement levels again here to kind of give an idea of where we might start seeing, just potentially some buyers step back in. So one of the levels that we just kind of penetrated today, or we're sitting at today, is right around this 200-day moving average. And if you look at kind of the S&P, that 200-day moving average is right around 3012, and that's basically where we're at right now. So let's say we break below that. Well, here's an area in the past where we had a hard time kind of getting above. We pulled back, and we were trading in this range, right? We were talking, and I think, Brett, even last time you and I were talking, we were talking about a 2800 to 2950 range, and well, we got through that fairly quickly, but I don't see this as a true negative that if we get back down into that range, find a little bit of a base, right? Because sometimes what happens is when the market moves up a little too far, too fast, it doesn't. You get that fear of missing out trade, and that's kind of what I saw happening over the last week or two. And I'll give you an example why. Over the weekend, we saw some data statistics talking about call buying on the S&P 500 and the spiders in general. And the call buying was the highest level that we had seen since basically the end of February. What does that mean? That means that investors who were concerned that they had not participated in a lot of this move from here to here said, okay, well, I don't necessarily want to go and buy the market right now, buy the S&P 500 or buy the spiders or buy the individual names, but let me go ahead and speculate by buying a levered product like buying a call option. That way, if the market goes up, my call option should increase in value. When I see everybody on the same trade, like I saw with some of the data that came out over the weekend talking about that, that tends to say to me that complacency is really high and that everybody just is continuing to expect the market to just go up. And I like to see a day like today. I know that might sound weird to people, but I actually like to see a day like today where you do see some of that rally exhaustion occur. You see a pullback and you see people really start to kind of, recollect on, hey, what is an appropriate level for me to try to get in at, because this whole chasing the market to the upside strategy might not work. And when you see something like that, when you see the market pull back as much as it did today, more than likely that means that there were some people that have been stepping in along this way, buying, and then, whoops, and then as you can see, you get that pullback, and they're maybe waiting for another opportunity. So I actually like seeing that. I don't know about you, Brett. Do you think it's healthy for the market to get a little bit of a pullback like we saw today?
I don't like it as much as you do. I have to admit, I'm a bond guy. We don't like anything as much as equity folks do, but I do think that let me highlight something you think you might find of interest as it relates to just what's going on today. I'm looking at a chart right now, Joe. I don't know if you're able to call this up. I'm looking at the intraday chart of what's happening in the market today, and what strikes me is kind of if I look at the Dow through the day, it almost seems like almost a straight line. I mean, it's a pretty smooth decline. Mm-hmm. And you and I might interpret these things differently. There's hundreds of different interpretations for these things. It means that there's no one event, but it's a very mood-oriented sentiment kind of marketplace. And it's not clear that that's the kind of market that really cares about fundamentals in the marketplace. This is one of those, it's negative, get me out. We've seen a massive rally. I don't care. I want to sell. It's certainly better. Levels are so much better than they were in March. I'm gonna just get out now and be glad I didn't get out back a few months ago. So just a thought on that.
I think that's good food for thought, and I think that it's actually a pretty wise kind of way to sum this up. In that, hey, when you do get that bounce back, like we saw, and you got to remember, not everybody was long at the same level, right? And so for the people that decided to step in at different levels on the way up, they get a chance to maybe lock in some gains or lock in a break even for some people. And they say, hey, I don't want it, I'm concerned about us pushing back down towards those lows. They got their opportunity. And as you said, today was, it's a pretty measured sell up. You're absolutely right. It wasn't like there was one data point that came out during the day where you saw a big flush down. You can see this from kind of the candle patterns. It was just a very measured move down. And so you're just seeing some measured liquidation, if you will. And up until this point, I think that, like I said, I think that that's fairly healthy. And we'll see kind of what the next few days bring. All right, Brett, I appreciate your help as always. Good talking to you, my friend.
Good chatting with you. Always a pleasure, Joe. Thank you.
And I want to thank all of you. You know what? We are not done for the day. I am, but you are not. Immediately following us, or maybe a better way to put this is at the top of the hour, you're going to get Fuel Your Trading with Street Smart Central. So you want to learn a little bit more about Street Smart Central, maybe some of the futures applications. We talk a lot about futures in terms of kind of watching them overnight, but if you want to kind of get into the trading mechanisms and how you incorporate that, you're going to find that out starting in about 13 minutes. So make sure you stay tuned for that. I want to thank all of you for tuning in. I will be back tomorrow to wrap up the week with our closing remarks. So thank you again. Everybody have a great day. Bye-bye.
You could think getting commission-free trades is as good as it gets, but you know better. At Schwab, you get commission-free trades and quality trade executions from the only firm that offers a satisfaction guarantee. Schwab, the better place for